Okay, so let's talk long-term investing. What can we realistically expect? Not just looking back a few decades, but like centuries.
Yeah, it's a fundamental question, isn't it? And it really impacts how you should think about building a portfolio or just setting your own expectations.
Exactly. And today we're diving deep into this using a Quantpedia article that summarizes a really important academic paper, Long-Run Asset Returns.
Right. This is the one by Chambers, Dimson, Ilmanen, and Rintamecki. It's quite something. They look at stocks, bonds, real estate, even commodities over 200 years, a massive historical view.
And our mission really is to unpack what all that history actually tells us, going beyond the usual narratives that, often just focus on more recent times.
We want to get into the details, the surprises, and yeah, the challenges of looking back that far.
Because as we'll see, the picture can look pretty different when you zoom out 2 centuries compared to just, say, the post-war period.
Absolutely. The past isn't always what we think it is based on recent memory. It's got some unexpected twists.
So this deep dive is definitely for you if you're thinking about asset allocation, or maybe just resetting your expectations based on, well, a much bigger picture.
It gives us that crucial context, a baseline that's maybe more grounded than just looking at the last 20 or 50 years.
Thank you for tuning in to Quantopian's Quant Radio, your AI-driven podcast exploring everything related to quantitative finance. If you enjoy this episode, don't forget to like and subscribe to stay updated on future releases. For more quant-focused content, join us at community.quantopian.com. There you can explore a wealth of resources, connect with fellow quants, engage in insightful discussions, and enhance your skills through our extensive range of online courses. Quant Radio is intended to help people develop their knowledge and skills in quant finance. This podcast is not intended to provide investment advice. And now, back to the episode.
Okay, let's get into it. So this huge scope, stocks, bonds, real estate, commodities, 200 years, why is looking back that far so critical? Why not just stick with, say, the last 70 years where the data might be cleaner?
Well, because so much of what we sort of take for granted, especially thinking about U.S. markets, comes from data starting around 1900 or maybe 1926.
Right, the standard data sets we often see referenced.
Exactly. And that essentially gives you the story of the 20th century. But the paper really hammers home the point that the 20th century might have been, well, a bit weird, historically speaking, anomalous.
Anomalous how?
In terms of returns, particularly the relationship between stocks and bonds. If you ignore the 19th century or data from other parts of the world, you might get a skewed view of what's truly normal over the very long run.
It's like judging a whole climate based on one unusually warm decade or something.
That's a great way to put it. But, and this is a big but, diving into that really old data comes with its own set of, let's say, issues.
Ah, the challenges. I was waiting for this.
Yeah. I mean, 19th century financial data, it's not like downloading clean numbers from Bloomberg. You've got quirks, gaps, inconsistencies, just figuring out what constitutes a stock market return or a bond yield consistently across centuries and countries. It's tough.
So we need this long view for context. We also have to be super careful about the data quality itself.
Precisely. The authors are very clear about this. How you handle these data problems, which periods you include, it can actually change the results you see.
So the idea that the past perfectly predicts the future gets even fuzzier when the past itself is kind of hard to read clearly.
Right. It definitely complicates that simple extrapolation. But even with all those caveats, having this 200-year anchor is, I think, incredibly valuable.
How's that?
It helps us frame things. It gives us a baseline, however imperfect, to compare against. It helps distinguish between what might be a long-term trend versus, say, a multi-decade blip. It forces us to build more thoughtful assumptions than just rolling forward recent performance.
Okay, got it. So it's about calibrating our view with the longest lens possible, warts and all.
Exactly. Grounded in the best evidence we have, even acknowledging its flaws.
Right, this is where it gets really juicy. Let's dig into the actual findings. What did this 200-year perspective show about equity returns? This is often the big headline, isn't it?
It really is. And the key finding is pretty stark. We all kind of know the 20th century story, right? Especially in the U.S., stocks massively outperform bonds. The paper quotes an equity premium, that extra return from stocks over bonds, of around 4% to 6% per year.
Yeah, that feels familiar. That's the bedrock of a lot of investment thinking.
But then you look at the 19th century in their data, and it's a completely different world.
How different are we talking?
We're talking an equity premium close to zero, maybe even slightly negative in some of the data sets they examined.
Whoa, hold on. 0 or negative. For a whole century, stocks didn't reliably beat safe bonds.
That's what the long-run data suggests for that earlier period. It's a massive swing from the 4–6% we saw later. It really challenges that core belief that a large equity premium is just this timeless, constant feature of financial markets.
Wow, okay. That definitely reframes things. What about bonds themselves? You mentioned the relationship change, but what did bond yields look like historically?
Historically, bond yields were actually much higher than what most of us have experienced in our lifetimes. Even back in the 19th century, during periods of relatively low growth and low inflation, real yields were considerably higher.
Higher than recent decades.
Much higher. The paper is quite emphatic here. They call the ultra-low yields we saw, especially in the 2000s and 2010s, historically unprecedented.
Unprecedented over 200 years. That's a strong statement.
It really puts the quantitative easing era and everything into a very long historical context. It suggests that anyone investing in bonds over the last, say, 15–20 years has been operating in an environment unlike almost anything seen in the prior 2 centuries.
Okay, so a near zero equity premium in the 1800s, much higher bond yields historically. What about corporate bonds? The credit premium.
Right, the extra bit of return you hope to get for taking on the risk of companies defaulting compared to, say, for government bonds. Here, the long-run evidence is a bit fuzzier, mainly because consistent, reliable data is harder to find before, say, the 1970s.
Ah, data limitations again.
Exactly. But based on what they could piece together, the suggestion is that the long-run excess return, the credit premium, is actually quite small, maybe around 0.75% to 1% per year.
So not a huge reward historically for taking on that corporate credit risk over the very long term.
It appears relatively modest, and again, with the caveat about the data limitations, especially in the earlier periods, it's harder to be really confident about that figure across all economic conditions historically.
Okay, let's shift to real estate. It's such a huge part of household wealth everywhere. What does the 200-year view tell us there?
It's definitely significant, no question. But the paper's analysis, which tries really hard to look at total returns, so that includes rental income, but also adjusts for costs, maintenance, quality improvements over time, mostly focused on housing.
Right, getting beyond just house price appreciation.
Exactly. And when they do that, the finding is that the long-run total returns from housing appear to be lower than those from equities.
Interesting. So even with rent factored in, historically over this very long time frame, stocks seem to have delivered more total return.
That's what the data presented indicates. But, and we have to keep saying this for real estate, the measurement challenges are substantial. Every property is unique, transactions aren't frequent like stocks, and accurately tracking all those costs and income streams over centuries is incredibly difficult.
Yeah, I can imagine. It's not like tracking a stock index.
Not at all.
Okay, last one. Commodities. This is fascinating because the conventional wisdom is often mixed. The paper specifically looks at a diversified portfolio of commodity futures. What's the story there?
This, I think, is one of the most potentially surprising findings for many people. We often think of commodities as maybe an inflation hedge or something very cyclical, maybe low return overall.
Right, just holding gold or oil or corn doesn't necessarily compound wealth over the long run. Spot prices can go nowhere for decades.
Precisely. Investing in spot commodities often yields low or even negative real returns. But the paper focuses on something different, a strategy involving a diversified portfolio of commodity futures, regularly rebalanced.
And what did that strategy show?
It showed a significant positive premium historically. They cite figures in the range of 3% to 4% annually over very long stretches, 150 years, 100 years, 50 years.
Wait, a 3–4% annual premium from a commodity futures strategy? Well, that sounds pretty good, almost equity-like in some periods.
Remarkably so, according to their analysis. The source even points to visual evidence suggesting this strategy nearly matched long-run U.S. equity returns over 152 years and actually beat equities since 1900 in their data.
Wow. Okay, that's definitely not the standard view of commodities. And this isn't about timing the market or predicting prices.
No. The key seems to be the diversified portfolio approach, using the futures market. Not just betting on the direction of oil next month, it's about the structural behavior of holding that kind of basket over time.
Very interesting. We definitely need to explore the why behind that one. Okay, so we have these intriguing, sometimes surprising historical results. Let's try to connect them to underlying theories or explanations. Why that a huge difference in the equity premium between the 19th and 20th centuries? What's the thinking there?
Well, this gets into the famous equity premium puzzle. Why was the 20th century premium so high, especially compared to the 19th? The paper doesn't offer a single definitive answer, Because, frankly, economists are still debating it.
It's still a puzzle then.
Largely, yes. The paper suggests the possibility that maybe both centuries were kind of abnormal. Perhaps the 20th was unusually good for stocks that globalization, technological leaps, maybe even some luck with avoiding worst-case scenarios in major economies like the U.S.
And the 19th.
Maybe unusually bad, or perhaps just more representative of periods with less established financial systems, more frequent crises, or different investor expectations. The research suggests we need more work to fully understand it.
So if both might have been outliers, what does that imply for looking forward?
It implies caution. Using either century alone as your guide could be misleading. That's why you see current expert forecasts for the future equity premium varying quite a bit. The paper mentions ranges like 0% to 5%. People are essentially trying to navigate between the lucky 1900s and the disappointing 1800s.
Right. The future might lie somewhere in between those two extremes. What about those high bond yields before 1900? In a slower growth world, that seems odd from today's perspective where we link rates to growth expectations.
It does seem counterintuitive now, doesn't it? The paper offers a few potential historical explanations. One is simple capital scarcity. There just wasn't as much accumulated wealth around looking for investment opportunities, so the price of capital, the interest rate, was higher.
Basic supply and demand for capital?
Kind of. Another factor mentioned is the impatience of savers. If many people are living closer to subsistence levels, they're going to demand a higher return to convince them to save and lend rather than consume immediately.
Makes sense. Any other ideas?
They also point to high financial intermediation costs. Think about how hard and risky it was to actually lend money safely across distances, assess creditworthiness, and force contracts back then compared to now. Those frictions and risks could have kept borrowing costs, and thus lending returns, high.
So the whole financial plumbing was just less efficient and more costly.
Exactly. It's a very different set of drivers than the modern focus on, say, expected future consumption growth determining real rates. It really underscores how the economic structure matters.
And for real estate, we keep coming back to the data challenges.
Yeah, it's worth stressing again. Every property is different. That's heterogeneity. They don't move immobility. And measuring the true total return, accounting for everything accurately over centuries, it's just inherently messy.
Makes comparative analysis really hard.
Very hard. And the paper also highlights that most of the available long-run data is for housing. We have much less historical information on commercial real estate, farmland, infrastructure, things that are arguably more relevant for big institutional investors.
So more research needed there, but the historical data is scarce.
That seems to be the situation.
Okay, finally, let's circle back to that commodity futures premium. If it's not about accurately predicting individual commodity prices going up or down, what's the theory for why that diversified portfolio generated positive returns historically?
The main explanation put forward in the source relates to diversification benefits and rebalancing effects. It's a portfolio construction argument.
Can you unpack that a bit?
Sure. Individual commodity futures can be very volatile, right? And crucially, their prices often don't move perfectly together. They have relatively low correlations with each other and also with stocks and bonds sometimes.
Okay, so different things moving differently.
Exactly. The theory is that if you hold a diversified basket of these volatile, relatively uncorrelated assets, and you systematically rebalance, meaning you sell the ones that have gone up and buy the ones that have gone down to maintain your target weights, you can generate a positive return over time.
The rebalancing bonuses or diversification return, it's almost like a mathematical effect from harvesting volatility across uncorrelated assets.
That's a good way to think about it. The paper identifies this portfolio dynamic, the diversification and rebalancing, as the most significant and empirically robust driver of that historical 3–4% premium they found. It's less about being smart about copper prices and more about the structural benefit of holding the diversified rebalanced basket itself.
Fascinating. So it's a strategy-based return rather than just asset appreciation. Okay, this has been incredibly insightful, looking at this huge sweep of history. But we absolutely need to talk about the caveats, the potential downsides, and the limitations here.
Crucial. Absolutely crucial. The number one caveat, always, is that the past doesn't perfectly predict the future. Historical returns give us context, maybe some base rates, but they are not guarantees. The world changes.
Right. Economic structures evolve, technology disrupts, geopolitics shifts.
All of that. And we've hit on the data issues multiple times, but it's worth saying again, especially for the 19th century, or for specific asset classes like corporate bonds pre-1970s, or even real estate generally, The data isn't perfect. There are gaps, estimations, potential biases. We have to take the specific numbers with a degree of caution.
Measurement problems too, especially for something like real estate total return.
Exactly. Trying to account for costs, quality changes, rental income accurately over 200 years is just inherently difficult and involves assumptions. Different researchers might come to slightly different conclusions based on how they handle those measurements.
You also mentioned the statistics, the use of geometric means. Why is that important to remember?
Yes, the returns reported are typically geometric means, which reflect the actual compound growth rate of an investment over time. For assets that are volatile, like stocks or commodities, the geometric mean will always be lower, sometimes significantly lower, than the simple arithmetic average of the annual returns.
So the compound return you actually achieve is less than the average yearly jump might suggest, especially if there are big swings.
Correct. It's the right way to measure long-term wealth growth, but it means the headline number might seem less impressive than an arithmetic average, and it implicitly accounts for the drag from volatility. It's important for setting realistic expectations about the journey, not just the endpoint.
And different data compilers might have slightly different results anyway.
Yes, depending on their sources and methodologies, you can find variations in historical return estimates. It's good to be aware that these numbers aren't set in stone.
And perhaps the biggest caveat for today is the starting point, particularly with bonds.
Absolutely critical. The paper highlights how unprecedentedly low bond yields were in the recent past. Starting from such low yields fundamentally changes the forward-looking picture. You simply can't expect the same kind of returns from bonds going forward, as you saw historically when yields were much higher.
And that also impacts the relative comparison with equities, right? The equity premium discussion.
Exactly. Extrapolating the high 20th century equity premium, which occurred when bonds offered much higher yields, into a future where bonds start with very low yields. Well, that requires careful thought. It might be overly optimistic to expect the same level of outperformance from stocks over bonds if bonds themselves are offering so little to begin with.
Okay, so pulling this all together, what are the really big takeaways for you, the listener, from this deep dive into centuries of asset returns?
I think the first one is just the sheer variability. Long-term returns aren't static. They've differed hugely between asset classes, obviously, but also dramatically across different historical eras, like the 19th versus the 20th century.
And related to that, the 20th century, which forms the basis of so much common knowledge in investing, looks increasingly like it might have been unusual, particularly for that high equity premium and, more recently, those rock-bottom bond yields.
Third, while we have to be honest about the flaws and challenges in super long-run historical data, it's still absolutely vital context. It helps us frame current conditions, question assumptions based only on recent decades, and set potentially more realistic baseline expectations.
It helps us understand the range of what normal might have looked like historically, right?
Exactly. And finally, looking beyond just the usual suspects like stocks and bonds to things like diversified commodity future strategies can reveal some surprising historical performance patterns. It shows that returns can come from portfolio construction effects like diversification and rebalancing, not just from simple asset appreciation.
So this whole exercise helps us move beyond simplistic assumptions, doesn't it? It gives a richer, more complex, maybe more humble perspective on what long-run investing has actually involved.
I think that's right. It provides a deeper historical vocabulary, let's say, to think about the future, to question the narratives we might take for granted.
It certainly equips you with a more nuanced understanding.
And maybe that leaves us with a final thought for you to chew on. If, as the research suggests, both the 19th century and the 20th century might have been abnormal in their own ways.
One with low equity premiums and high real rates, the other with high premiums and eventually super low rates.
Right. If both were potentially outliers, what might a new normal actually look like going forward? Is it something in between, something completely different? And how should that uncertainty, that possibility, shape how you think about your own expectations and strategies today?